Hi everyone, my name is Bob Christoffel, the Manager of Benefits Education at Wespath Benefits and Investments. Welcome to your pre-retirement webinar for 2021. With me is Todd Creviston. He'll be co-presenting some information. Working behind the scenes will be Frank O'Brien, our benefits educator. Please ask questions through the Q&A functionality of your toolbox. And also Cheryl Hatcher is here. She is our Senior Benefit Plan Specialist and webinar host. We're going to focus on the retirement process today. I want to encourage you to ask questions. We have a large registration today. We're going to attempt to get to all of your questions throughout this webinar. There is an attachment on your toolbox which really describes what you need to know about the retirement process. It's a really good reference. And this really is very much a process. You come to a webinar. We will have retirement webinars next spring, as we always do. Many of your annual conferences also offer conference-specific retirement webinars. We have a retirement team at Wespath dedicated to each year's retirement class, as well as the assistance of the benefit education team with consultations, individual private consultations in 2022. So let's get started and ask the question, what do I need to do if I'm actually retiring next year? Verify that all of your personal information is correct on Benefit Access. Benefit Access is your portal where at some point you'll actually make your retirement benefit elections. But you also want to check that your spouse's information is correct. And why is this important? Well, your spouse is entitled to receive survivor benefits from your retirement plan. So it's real important to make sure that the spouse is in there and the date of birth is in there correctly. Also, take a look at your clergy service record. We call that CSR, and that has to be accurate. That information gets reported to Wespath, and the reason it becomes so important, we'll use that clergy service record to help calculate some of your benefits like the Clergy Retirement Security Program defined benefit. You want to look at your Lifestage investment management profile. Many of our participants, both clergy and lay, are utilizing Lifestage investment management. So you want to take a look at your profile, make sure it has your correct benefit commencement date, risk tolerance, eligibility for Social Security benefits. Start to use the benefit projection tool where you can put in a specific date of time to take a look at what your benefits will be projected to look like. Take a look at your beneficiary designations. That's important both during your active careers as well as your retirement. And you want to make sure that you have the primary beneficiary and also contingent or secondary beneficiaries listed correctly. How do you do all of this stuff, all of this verification? It's a really good question. That's on Benefit Access. I would encourage you, if you haven't already, please register for Benefit Access. We've made the process easier and safe and secure. But this is where you're going to find your profile, your personal information on your spouse, the name and date of birth. You can view your clergy service record, which is just so important, your Lifestage profiles, and run some benefit projections and other tools like the retirement readiness tool to project what expenses will look like and identify if you'll have a gap in your retirement income. All that information can be found at benefitaccess.org. So please do that and get familiar with Benefit Access. We often get asked, what about retiree health benefits? That is not the focus of this pre-retirement webinar, but I would encourage you to check in with your annual conference. Obviously, this is real important. What about housing? I did a consultation earlier with the clergy and I discussed housing. They were in a parsonage and were planning on leaving the parsonage next year. So think about where you're going to be, where you want to live. Will you be renting initially, or do you need to purchase a house? Have you planned for that? Think about how much can you actually afford in housing and how to best secure a down payment for these housing. These are complex questions, and I would encourage you to make a call to the EY financial planner line. I know that many of you have worked with EY already. You can have these discussions with them about housing, securing down payments, but also while you're there, get a comprehensive and personalized financial plan with EY. You're going to need to notify that you are retiring. So you want to notify your bishop. You want to notify your cabinet, the Board of Ordained Ministry, within 120 days of your retirement. And then make those calls to EY, make those calls to our retirement team, set up a benefit education consultation next year. And now we can finally talk about money, income, and where will this come from. And we'll start with the Wespath retirement plans. But that might not be all. You might have other sources of retirement income available to you. Later on, Todd will talk about Lifestage retirement income and delaying Social Security retirement benefits to maximize those benefits. You might have personal savings, IRAs, or your spouse might also have access to retirement plans. This chart, and those of you that have been in ministry for a long time, you know these plans have changed. They've evolved. We currently exist, and I'm going to start with that plan, the CRISP, C-R-S-P, Clergy Retirement Security Program. That's the mandatory plan right now for eligible clergy. Prior to that, we will talk about MPP, the Ministerial Pension Plan. Some of you might have what we call now the Pre-82 plan, the Minister's Reserve Pension Fund. And off to the right, that green circle, that's a real important plan that Todd is going to speak to you about, the voluntary United Methodist Personal Investment Plan. So let's start with CRISP, and the plan design of CRSP, in my mind, that's what makes this plan just so special. You have the advantages of a defined benefit, a lifetime benefit for you and your surviving spouse, lifetime income, but also the flexibility and the control of a defined contribution plan. And I always tell the retiring class, focus on the defined benefit plan first. Make those decisions. Those are, quite frankly, they're more complicated, so you want to focus on that. You have to make decisions which are not revocable. And I want you to understand fully all of the choices, all of the decisions, and when those benefits need to be commenced by. So we'll look at this defined benefit component of CRISP. First thing I'll tell you, you're not going to find it on your statements. Okay, you'll find an accrued benefit and benefit access. But quite simply, it is not a balance. It's a formula. So it's not subject to market fluctuations. We're using math. We're going to be multiplying three factors together. And I think it's important to understand what these factors are. The first one is the denominational average compensation. We call that at Wespath the DAC. And that is multiplied by a factor of either 1.25% or 1% for different periods of service. And then the third factor we call credited service. So we're multiplying these three things together. What exactly is the DAC? That's the first factor. Well, we call that the denominational average compensation, which is the average plan compensation, but only of clergy serving full-time appointments. And what we have seen, and when you run your own benefit projection, what it assumes is that there is growth in the DAC, because we've seen that of about 2.5% a year. We've seen it grow from 2020 to 2021, and we know what the DAC is going to be for those retiring next July 1st. What about that factor? Well, the factor used is for two different periods of service. The first one, when MPP went away, gave birth to January 1st, 2007 CRSP. Through the end of 2013, we use a factor of 1.25%. But there's additional service for you, beginning January 1st up until that June 30th of the year that you're going to retire. So for next year's retirees, we'll be using that factor of 1%. Now, what about the credited service? That's the third component. If you served a full-time appointment from January 1st through the end of 13, it's 7 years of credited service. And if you're retiring next June, you'll get an additional 8.5 years, 8.5 years, 8 and 6 months of credited service. So I'll give you an example of the calculation that goes on at Wespath. Again, we're just multiplying three different factors together, so it's easy math. We know what the 2022 DAC is going to be. We have the factor, and we have 7 years of service. When you multiply that together, you get an annual amount. We'll simply divide it by 12. Pensions like this are not paid annually, they're paid monthly. And then we'll look at the second period of service. And you'll notice the only thing that really changes here is the factor changed and the years of credited service, but the math didn't change. We come up with an annual amount, and again, we're going to simply divide it by 12. So now we have these two amounts. What do we need to do? Just get out the calculator and add them together for a monthly benefit. So we'll pause for a second. We're looking at that monthly amount. There are decisions that you make that will impact that monthly amount. And I like to review those decisions with you because they impact your monthly benefit. There are different annuities to choose from. Surviving spouse annuities, single life annuities, those will impact that amount. But also a very important decision about an increase, and that's a good thing, a COLA we call it, cost of living adjustment. The minimum COLA for CRSP defined benefit is 2%, but you can also elect 3%, 4%, or even 5%. I'll give an example later of the impact of these different COLAs when we talk about the ministerial pension plan. Also, what could impact your monthly amount is early retirement. Early retirement outlined in the Book of Discipline is when you've reached the age of 62 or, not N, but or 30 years of service. You're going to receive a reduction in your benefit to account for that early commencement. And I have a quick example of the impact of an early retirement. And in this example, the clergy person doesn't have 40 years of service. That's considered a normal, 65 or 40, so they're short. Okay, well, I'm going to say here they have 35 years of service, and they're exactly 2 years on the age early. They're 63. The way the reduction is applied, every month counts. It's 0.5% per month or 6% per year. 12% for a 2-year early commencement would bring that benefit down to $956. This example, the participant, would still choose an annuity type as well as a cost of living adjustment. So when you run a projection with an early retirement date, it'll take those reduction factors into account. So that's a lot and some complex decisions. I'll walk you through examples of the annuity when we talk about the ministerial pension plan. So you want to focus on that DB component first, because the DC, that's easy, and that balance is going to be there. And you don't need to do anything with the DC balance until you reach the age of 72. So what exactly is the DC balance? It is made up or comprised of matching and non-matching contributions that you have received over the years. Some of our participants are directing the investments for the DC component. Still others are using Lifestage investment management to kind of take that burden of self-managing off their shoulders. They're comfortable with the investments, they understand the goals of the investments, and they're self-managing. But this money is available to you. You may need it immediately. It's available as a full cash distribution, partial cash distribution. A lot of our participants will simply just roll it over right into United Methodist Personal Investment Plan, but you can also roll it over out of Wespath. You want to be careful with that because of the housing allowance exclusion that you'll enjoy as a tax break in your retired status. But you don't need to do anything until you reach the age of 72. And that's when the government says, all right, you have to start taking out something. Required minimum distributions at least need to come out of your accounts. And upon your death, any remaining balances don't go to Wespath or to your annual conference. This is your money. Upon your death, it's only going to go to your designated beneficiary. And that's why I had mentioned earlier, it's good to make sure that those are correct and updated as needed. So that's that clergy retirement security program, the current mandatory plan for eligible clergy. And then there's a lot going on there, 2 different periods of service, 2 different components in the plan design, the defined benefit, the defined contribution. Certainly a lot to consider, certainly a lot to think about. But let's go back further in time. Many of you will have a ministerial pension plan account, and that plan existed from 1982 all the way through the end of 2006, and then the next day, January 1st, 07, that's when CRSP started. So what is it right now? Well, it is an account balance. How is it invested? No participant is self-managing their own MPP account. It's managed by Lifestage Investment management. What about later on at retirement? Well, that's a really good question. What happens really? What becomes of MPP? Currently, 65% of MPP becomes a lifetime annuity. And an annuity is very important because you can't outlive that annuity. The other 35% continues to be an account balance, which gives you a lot of control and flexibility. So when you put them all together, you have two different components. Lifetime annuity, 6 different annuity options to choose from. And I want you to understand the option that you choose. Obviously, that's important. But I also want you to understand the other 5 that you did not choose, because these decisions are not revocable. You're also going to have a COLA in MPP, an annual increase, and that's a good thing for a retirement person, an increase in their income every year. I just want to be clear that the decisions that you make with MPP, in terms of the annuity, in terms of the COLA, don't have to be the same exact decisions you make with CRSP. You could choose a different annuity, a different COLA. And then that 35%, a lot of flexibility. That money will continue to be invested, earning and growing. So let's review. Let's take a step back. MPP, this one does appear on your quarterly statement, and you'll see that asset allocation that was set up by Lifestage Investment Management. And as you gradually approach your benefit commencement date, Lifestage has scaled back your more aggressive investments, and we've seen that with the last couple retiree classes. Take a look at those statements, look at those asset allocations. 65% of that balance right now can become a lifetime of income for you and your spouse. So you want to really consider all of those options very carefully and think about a COLA. Now, I had mentioned that in CRSP, the minimum COLA was 2%. With MPP, you're going to have COLA options, but you have an additional option, a 0% or no increase, all the way up to a 5% compounded increase. And I will explain really what's the impact of these different COLA options. And then that 35% continue to be an account balance, flexibility, you can take partial distributions. What I see on benefit access, a lot of our retiring participants will simply check the box that says, I'm going to roll that over, that 35%, right into the United Methodist Personal Investment Plan. So the takeaway here is just a lot of flexibility. So when I'm looking at MPP, remember I said with CRSP defined benefit, take care of the defined benefit first. Focus on that, not revocable. Same thing with MPP. I would say take a look at that 65%. If you need to annuitize that right from your retirement date, consider what you want to do with that 65%. What is an annuity here? It really is just a stream of monthly direct deposits that you can't outlive. So I think that's comforting to know that you're never going to say, next year, next birthday, next month, my pension stops, the annuity stops. No. And if elected at the time of your retirement, that annuity can continue uninterrupted to your surviving spouse. So really lasting 2 lifetimes. Wow, that's really valuable. All of the annuity options provide you with this lifetime of income. So I don't want you to think that there's a bad annuity out there, that if you choose that, it's not going to be a lifetime. They all provide a lifetime of income, and all, if elected, can continue to your surviving spouse. So let's look at an example. And I'll just remind you that this is no one here's exact benefit. It is just an example of a clergy person with an MPP balance. They're 65. They've chosen a 2% COLA, and they're looking at the different annuity types. You see 3 different ones. I like to call these joint and survivor annuities. Sometimes they're referred to as life and survivor annuities, 2 lifetimes of income. You see life in 70, life in 85, life in 100 along those annuity type rows. You also see 2 columns with dollar amounts. Keep in mind that Wespath does not pay out both columns at the same time. No. We pay about the column payable to you. That goes out first upon your death. A percentage that you have elected continues uninterrupted to your surviving spouse. So if you're looking at this chart, you might realize quickly that the highest dollar amount payable to you right now out of the gate is $915. 2% COLA, you pass away, 70% of that amount continues to your surviving spouse. And you want to look at this from really a financial and income planning perspective. Is that 641 going to be enough combined with the other benefits? Maybe, maybe not. Also consider the life and 85% annuity type. And you'll notice two things happen. The amount payable to you goes down to 890, but a larger percentage continues uninterrupted to your surviving spouse, 757. You might think that's not enough. Let me also consider the life and 100%. And there you see 100%. The same amount of income continues uninterrupted to your surviving spouse. So you're not allowed to make these decisions until the weeks and months before your retirement, because there you should have more clarity on what your situation looks like. Several years from now, will you be married? Will you be divorced? Will you be in good health? Will your spouse be in good health? These are important things to think about. In addition to what will the income needs of the surviving spouse look like? What other sources of income will I have available? These three life and survivor annuities are really the standard form of payment for a married clergy person. Optional forms of payment would be a single life annuity. If you're married and choose a single life annuity, your spouse would have to understand, agree, consent, and waive their right to receive such a survivor benefit. And there might be sometimes everyone's situation is different, but there might be reasons to consider that. These are called SLAs, single life annuities. And again, this is just an example, not anyone's exact benefit. Everyone's financial circumstance is different. Everyone's benefits are different. But these amounts are higher, and there's a reason for that. Single life. They're only paying a benefit for one person's lifetime, and we just don't know how long that's going to be. Give you a couple examples. In this chart, the highest amount payable to the participant is $1,056. Single life annuity, they choose that. They live 33 years in retirement. It continued uninterrupted with the COLA. That's good. But what about the opposite? Someone picks a single life annuity, and 6 months into retirement, unfortunately, they pass away. Payments stop after 6 months, regardless of how long they were in ministry, regardless of what that 65% of the annuity balance was. Sometimes, in the case of a clergy person who has significant health issues, they might also look at the life with 5-year certain or life with 10-year certain. I like to call that 5-year guarantee, 10-year guarantee. Again, none of these options, the amounts payable to you will stop. But under the 5 and 10-year option, payments might stop for someone else. I'll give you a couple examples. Let's say you choose the life with 5-year certain. The amount goes down a little bit. So take a look at that on a projection, okay? If you outlive the 5 years, payments continue. But where it kicks in, let's say, for example, you pick the life with 10-year certain. You want payments to go out for at least 10 years, and you die after 7 years in retirement. We look at it, we say, well, that 10-year certain period is not up. There's 3 years left. Anybody that you've designated will receive those monthly payments, but only for the remainder of the term, in this example, for the next 3 years. Who can that person be? Anybody. It can be a church, it can be a family member, a partner, brother, sister, parent, child, anybody that you designate. It can be a minor, a child. Age is not a consideration in this calculation. So really, a lot to choose from, those 3 single life annuities or the 3 joint and survivor annuities. But then you also have to think about the COLA. And a COLA is really good. I've seen plans that don't have a COLA. We all know about inflation, and I think we all know that $1,000 a month of income today is not the same as $1,000 a month of income 3, 5, especially 10 years from now. So these COLAs become just so important. It's an annual increase in your benefit. Social Security has a COLA where they do an adjustment. They just released some information about that recently. How big is the COLA? Well, when you run a benefit projection or you go into benefit access to make your elections, you're going to see the default COLA, 2%, will be highlighted. That is not an election, but it's the default. The minimum for CRSP is 2%. For MPP, you can also choose a 0% COLA, but you can go higher, 3%, 4%, or even 5%. So you might be looking at this and saying, well, Bob, why doesn't everybody just pick that 5% COLA? That's a significant increase. That'll help me keep up with inflation. Does the COLA impact your initial benefit amount? That's a fine question. And the answer is a very loud yes. The COLA impacts your benefit amount. And I want to show you a quick example. And the dollar amounts aren't that important, but the concept is important. Different COLAs to choose from, including 0 for MPP. Now the pink line, that represents the default COLA. Slow and steady, 2% increase every year. Let's focus on the two extremes. Let's say somebody wants to look at in MPP a 0% COLA, so they don't want to receive an increase. Why would they do that? Well, take a look at that red line. They're going to receive a much higher monthly benefit initially. So they get to enjoy these higher payments. But eventually there's going to be a crossover point where they could end up with longevity receiving the lowest monthly payment. But they did get to enjoy those higher payments for a period of time. The other extreme would be the 5% COLA. 5%, that's a significant annual increase. And if you look at that orange line that's plotted, you'll see that a 5% COLA is going to bring your benefit down initially, but every year it's going up 5%. You will reach a point in time with longevity where you actually end up with the higher benefit. So a lot to think about with the annuity types, certainly a lot to think about with the COLA. Let's summarize what we've discussed with MPP. You don't need to do anything until you reach the age of 72. So for example, if you were looking at a normal or even an early retirement and don't need this money yet, you can leave it behind. It'll still be invested, hopefully still earning, hopefully still growing. At the time of your retirement, or anywhere up to 72, you can choose an annuity option, choose a COLA, and get started on MPP. And there's different ways to do that. You might need the 35% initially next July 1st, maybe for a down payment. You might need to take that out and need it, and you're going to wait on the annuity portion of MPP, the 65%. Or you could do the opposite. You could say, I'll take the annuity right now, that 65%, I'll get that going, but I'll wait on the 35%. So there's different ways to approach this. Again, most participants I've seen anyway simply roll over the 35%, consolidate it into the United Methodist Personal Investment Plan. You also have the option to roll it over outside of Wespath to another retirement plan. Obviously, you want to think carefully about the housing allowance exclusion preservation. And then you have other flexible distribution options. So, wow, we've covered a lot of information. We talked a lot about CRSP, the two different components, the MPP, that's 65-35, the annuity types, the COLAs. What about the pre-82 plan? Some of you here on this webinar might be entitled to receive a pre-82 benefit. When you run a benefit projection, it'll show you in the top part the lifetime income, because that's what's great about the pre-82 plan. It does provide you also with this monthly annuity, this monthly direct deposit that lasts your lifetime. Now, most annual conferences, but not all, have two different ways that we're going to calculate this. DBSM, defined benefit service money, and a traditional formula benefit, kind of similar to what we did in CRSP using math. The point I want to make is that you will always get the highest of the two calculations. If we're using the past service rate, the defined benefit service money, or the formula benefit, we're going to calculate it two different ways, but always give you the highest of the two. I have an example of an annual conference that has a past service rate of $700. The way we do the formula benefit is very straightforward. We multiply years and months of pre-82 service times the past service rate, and again we get an annual amount. We'll simply divide by 12 and get a monthly benefit. So we'll hold that number aside, and then we'll look at the defined benefit service money, what that has grown to. We'll annuitize it and come up with an annual amount, divide it by 12, get a monthly amount, and then we just compare the numbers, and we'll automatically give you the highest of the two calculations. Now, you don't have all these 6 annuities to choose from. It is set. If you're a single clergy person at the time of your retirement, it's a single life annuity. It lasts as long as you do. If you are a married clergy person, each annual conference has set the survivor percentages. These are the examples. Some conferences have 70%, 75, 85, and some have 100% to the surviving spouse. But please keep in mind that it's the spouse during your Episcopal appointment, at the time of your retirement, and when benefits actually begin. So you don't have these choices, and there is no COLA increase in the pre-82 benefit. So that's how pre-82 works. We've covered a lot, and I'm going to focus on the voluntary plan, the United Methodist Personal Investment Plan. Todd is going to speak to you about the importance of making a difference with that voluntary plan. I'll be handling your questions, so please continue to submit your questions. And I want to thank you for joining us today. I'll introduce Todd Creviston, Benefits Educator, and I'll give him the clicker. Thank you, Todd.
Thank you, Bob. Hi, everyone. Bob had referred to the UMPIP program as the voluntary plan, and that's exactly what it is. It's a defined contribution plan, and you can see this account balance on your quarterly statement. We hope that everyone is contributing to their UMPIP plan, including clergy, and we're hoping that you're at least contributing 1%, because Bob had alluded to earlier, if you're contributing 1% to your UMPIP account, you'll receive a 1% match into your CRSP DC account. So definitely a great way to save for retirement. A couple different ways to contribute to your UMPIP plan. You'll be contributing through your paycheck on a monthly basis, and you can contribute on a before tax basis. That will help avoid taxes now. You can contribute as a Roth contribution. That helps you to avoid taxes later. And then you can also roll over a IRS qualified plan like a 401k, 403b, or a 457b. Sounds like alphabet soup, but basically those are IRS qualified plans. You may have worked for a prior employer, and that's the retirement plan that you can roll that into your UMPIP account. I did that a couple of summers ago, and it's definitely streamlined the amount of paperwork that I need to look at each quarter, because I do like to review my quarterly statements. I eagerly await them in the mail. So 3 ways to contribute from your paycheck. Before tax is what the majority of the participants do. You can also contribute on an after-tax basis, or even contribute Roth contributions, which is a form of after-tax contribution. Before tax contribution, it's exactly what it says it is. You're actually making a contribution to your UMPIP account before you pay taxes. That lowers the amount of tax that you pay each year. Those contributions and earnings grow tax deferred until you take a distribution. Clergy have access to the housing allowance exclusion and retirement, which allows them to exclude income from federal taxes. A wonderful tax break that I'll cover more in a little bit. Roth contributions, those are an after tax, and those contributions and earnings grow tax deferred as well. The distribution will be tax free if you meet these 2 qualifications. The first is that Roth contribution, the first Roth contribution, needs to be made at least 5 years prior to your withdrawal. Okay. The second, you need to be at least 59 and a half years of age or older, or permanently disabled, and then those contributions are tax-free. Are Roth contributions right for you? I'm technically not qualified to answer that question for you, but EY is a wonderful resource to help answer that for you. The contribution limits for 2022 were just released, so they're hot off the presses. The before tax and Roth combined for next year is a big number. It's $20,500. For those folks over 50 years of age, myself included, you can contribute an extra $6,500. Those are called catch-up contributions, for a total of $27,000. That is a big number, and it's likely too big of a number for everyone to contribute that amount. What we'd like you to do is take a look at what you can reasonably afford and then begin at that point. As you move through your ministry and as you accumulate years of service, if you have an opportunity to increase that, that would be wonderful. My wife and I have a deal with each other that whenever we get a raise, we increase our contribution to our respective plans. I contribute to UMPIP by 1% each year. That way we don't miss that money. But our balance in our retirement accounts are growing, and that's key. Bob talked about this a little bit earlier. The distribution options for UMPIP as a retired participant, these are the same as the CRSP DC. And essentially, you can take a full lump sum distribution. That means you can roll it all out. We like to recommend that the clergy person contact EY to discuss any tax implications with rolling out a large sum of money, and then also having that conversation around the potential loss of the housing allowance exclusion with that money. Next would be a partial lump sum distribution, so that might be withdrawal of $5,000 or $10,000. Maybe you want to go on that vacation that you've always wanted to go on, but we're too busy in ministry. Maybe it's to fix the roof or update the kitchen. That choice is up to you. Your next option would be to have monthly cash installments, and this would get deposited into your bank account each month. You can self-manage that. So in Benefits Access, you'd actually enter the amount that you wanted to receive each month, and Wespath would put that into your account. The other option is using Lifestage Retirement Income. Lifestage Retirement Income actually calculates a monthly payment for you. It's designed to calculate a payment within a safety zone with the goal of it lasting a lifetime and to provide an annual increase. Because it's an account balance, there's no guarantee, but it does offer a high probability that a payment will continue for your lifetime. Bob also talked about this earlier with the CRSPDC and actually the MPP. If you don't need the money when you retire, you can leave it on account, leave it invested with Wespath until RMD age, and that's essentially the age of 72. With all the account balances, any balance remaining at the time of the clergy person's passing, that balance will be transferred to beneficiaries. The three ways to invest with Wespath will begin on the right. So the first is to choose your own investments. That works for some folks. That means that they've sat down, they've gone through all the different funds, and they've chose the funds and how to allocate their contributions from their monthly paycheck. Okay, that works for some. Others like to use EY and have an asset allocation consultation. So essentially, EY is going to help come up with that mix of funds. The third is using Lifestage Investment Management. And this is a tool that actually places your account on Autopilot. It's a personalized investment management tool for your defined contribution accounts. So this is for CRSP DC and UMPIP. We like to say that it sets your account on autopilot because it will determine or tailor the funds and the allocation of your contributions to each participant with those variables below. That includes the participant's age, when you're expected to begin benefits, the benefit commencement date, your risk tolerance. Are you a conservative investor, a moderate investor, or an aggressive investor? And then the availability of Social Security benefits and potentially other Wespath investments. To summarize Lifestage Investment Management, that creates that diversified portfolio for you so you don't have to. It'll also rebalance your account as needed. So it's normal for your account to grow or drift. When that happens, that rebalancing brings it back into your Lifestage Investment Management profile. Lifestage Investment Management is available for you through active service and into retirement. So now let's talk about Lifestage Investment Management's brother, Lifestage Retirement Income. These two work together. So Lifestage Retirement Income calculates a monthly payment for you from your account balances. As part of selecting your benefits when you retire, you can roll your CRSP, DC, and the 35% of MPP into your UMPIP account. So you can roll that into your UMPIP. I apologize for the multiple acronyms there, but you basically can roll your defined contribution account for CRSP and your 35% of UMPIP or 35% of MPP into your UMPIP. Lifestage then calculates a monthly payment from that consolidated balance. The goal of Lifestage retirement income is to try to make that account balance last a lifetime and to provide an increase in your payment each year. Based on market performance, a decrease is possible, but it will give you a high probability of that payment lasting a lifetime. The new payment is calculated each November. You'll then be notified in December of what your new payment will be beginning in January. So if you're in Lifestage retirement income, that means that your account balance will be managed by Lifestage Investment Management. They work together. So now for 2022, I would like to introduce two new features, and the first is the Social Security Bridge, and the second is the Longevity Income Protection. The Social Security Income Bridge is designed for you to delay taking Social Security so that you can maximize it. The Longevity Income Protection is an annuity contract that will guarantee income later in life. So with the Social Security Income Bridge, what we're trying to do is provide additional income, or the income that you would receive from Social Security, through Lifestage retirement income. That will give you the ability to delay Social Security. The way Social Security works is if full retirement age is at 67 and you delay it, your monthly benefit will go up 8%. So you can delay it for 3 years. So that's 8%, 8%, 8%. That's actually a 24% increase in your Social Security benefit. That may be helpful down the road. While you're delaying Social Security, you'll receive a higher payment from Lifestage retirement income. When Social Security kicks in at 70, then the amount you receive from Lifestage retirement income kicks in, and it'll actually level down so that it'll help to save that account balance into the future. The Longevity Income Protection, at the time of retirement, you will be able to purchase a Longevity Income Protection. It's basically an annuity contract, and that will kick in or begin at the age of 80. When that payment begins at the age of 80, that's another source of income in retirement, and as a result, that Lifestage retirement income payment will then decrease. This is a nice illustration of what it looks like. I think this part really hits a home run as far as those previous slides that I talked about. So in the early stages of retirement, 67 to 70, you'll be receiving income from Lifestage retirement income. At 70, when Social Security begins, you'll see the darker blue piece is Social Security, and as a result, the amount that you're receiving from Lifestage will decrease. At 80, when the longevity income begins, you'll see that Lifestage reliance on that Lifestage retirement income decreases even a little bit more, thereby protecting that balance for the long haul. So now the housing allowance exclusion. Bob and I had talked about this a little bit. It is a wonderful tax break for clergy in their retired status with their annual conference. It is available to multiple denominations. It's just not for UMC. Wespath has actually helped to fight to keep this in place, and it's a terrific tax break. So how much can you exclude each year? Well, it depends. It really depends on each of these three amounts. You'll need to go through each of these different scenarios to come up with how much can be excluded. The first is pretty easy. It's the amount that's designated as the housing allowance and that generally comes from annual conference. It's a resolution that's passed. I've only heard of annual conferences passing 100%, meaning 100% of the income that you receive from Wespath in retirement can be excluded. I haven't traveled to all of the annual conferences yet. I hope to soon, maybe in 2022, maybe in 2023. The next scenario requires you to do a little bit of work. That would be to keep track of all of your expenses. That includes mortgage payments, utilities, homeowners insurance, lawn service. You can even keep track of paper towels and Windex. So all of the expenses to live in that home for that period of time. The next piece is the fair rental value of your home, and that would include utilities and furnishings. I've heard of clergy using a local realtor or a local appraiser to come up with that number, or potentially using an online service to come up with that. In each of those scenarios, or I should say for each of those scenarios, you'll want to keep record of how you came up with each of those numbers, should you be asked by the IRS. Real quick example. So in this example, the clergy person received $24,000 in pension. 100% of that has been designated as the housing allowance exclusion. So that's our amount for the first scenario. The second scenario, the clergy person spent $20,000 to live in that home for the year. The fair rental value was determined to be $21,000. As we learned in the prior slide, it's the least of those three amounts. So the least of those three amounts is $20,000. So the housing allowance exclusion cannot exceed that $20,000. Now we do a little bit of math. It's fun math, because you'll take that $24,000 that you received from Wespath minus $20,000, and that means that your taxable, the amount that's taxable for that period of time, is $4,000, not $24,000. So terrific tax break on that. Here is the housing allowance exclusion worksheet. This was put together by Wespath. It actually looks like an IRS document. They did a great job, although that wasn't the purpose. The purpose on this is to help quantify and help walk you through and explain what each of those scenarios mean and how you come up with them. If you use a tax preparer, I would suggest that you provide this to them, as well as you can also talk to EY. They're a wonderful resource on the housing allowance exclusion. So it's available to retired clergy in the retired status with their annual conference. It's not transferable to the surviving spouse unless that surviving spouse is also clergy. There is a note on the back of that housing allowance exclusion worksheet that provides a sample note on what to include when you submit your 1040 to the IRS. So now let's talk about a benefit projection. Personally, I love running a benefit projection. When we have consultations with clergy, I love when they want to run a projection, because it's fun. It's a great way to explain and to demonstrate how your benefits work, and how they each work, because they are all on that benefit projection. So it's not a forecast, but it's changeable, and it's a changeable estimate based on a number of things. So account growth. So the account growth for MPP, the default is 4%. For the DC accounts, so for CRSP, DC, and UMPIP, the default growth is 7%. Bob had talked about the inflation, or the assumed increase in salary with the denominational average compensation, the DAC. So that's also in there. It's assumed at 2.5%. But then you can also put in your commencement date. You could change your commencement date and run a projection. So it could be that you retire when you're 62, or retire when you're 65, or you can go out to 72, any year in between. I like to tell clergy that when I'm showing them how to do that in a consultation, you can't break it. You can't break the system. It's designed to be used. And it's not uncommon for me to run a couple different projections for them, just to demonstrate the different scenarios. You can run it at life in 70 and a 5% COLA, life in 100 and a 2% COLA. So lots of different ways to see how your benefits will work for you. This is an example of the or screenshot of the benefit projection, uh, and you can also it'll pop up as a PDF, and then you can also print it out for your records. Actually four main pieces. Up top in the right hand side, you'll see the benefit commencement date. That's important because that will potentially change the payout or what you'd receive for each of those benefits. So it's so you could run one for 2022 or 2028. It's up to you. The top section there is a lifetime income. It will show a monthly benefit for each of the different annuities. And so you have CRSP DB annuity, you have MPP, that's 65%. And Bob also talked a little bit about pre-82, that pre-82, so this is a long tenured clergy person, they actually have a little bit of pre-82 there also. Each category is then subtotaled, so you'll see a subtotal for the lifetime income. That's the guaranteed, can't outlive it. If you select a joint annuity, it'll actually cover 2 lifetimes. The middle section, the account balance. For convenience, the Lifestage retirement income will calculate a monthly payment based off of the projected account balance on your commencement date, your benefit commencement date. So it'll show your 35% of MPP, what that looks like, your CRSP DC, and then it'll also show your UMPIP. In reality, when you receive your monthly distribution from your account balance, from your UMPIP account using Lifestage, you'll just get one payment because at that point it'll be a consolidated balance. But it's nice to illustrate the payment for each of those different balances on the projection. And then at the bottom, you'll see the total income that you'll receive based on this estimate, and then an estimated income replacement ratio. This estimate doesn't include Social Security, so you could probably add another 30% on top of that estimated income replacement ratio. So now let's talk about EY. What else can I say about EY? It's confidential, professional financial counseling at no additional cost to you. We can't say it's free because Wespath actually pays for it as part of our operating budget. Off of the from our fees. So, but it's no additional cost to you, meaning you're not going to be charged for using it. It's objective advice. There's no sales pitch. EY won't sell you anything. They're all financial planners, so they have been trained in all of the different types of funds that are available to you, all of the different types of retirement plans, MPP, CRSP, DC, DB. They understand all of that. In addition, they also have a great understanding of the tax consequences and the different tax scenarios for clergy, as well as the housing allowance exclusion. So they are well prepared to provide you with that objective advice. You could reach them at that 800 number there. You can also set up that EY Navigate account, and you just go to that web address. You'll actually create your own username and password, and that is well worth the 5-10 minutes that it would take to set that account up. Actually, probably more like 5 minutes. There's so much information in there about managing debt, setting up a budget. It's a wonderful resource. Definitely well worth the 5 minutes to do that. So action planning. So I have a little bit of homework for you. The homework isn't due today. It's not due tomorrow. I would say it's due in the next couple of months. We're coming into a busy season, right? With Christmas and Thanksgiving. And so what I'd like you to do is take a deep breath and relax. For those folks who aren't registered in Benefits Access, please do so as soon as you can. It is a terrific resource for you. Then everyone should go in, like Bob had mentioned, review your service record, look at your personal information, make sure that's correct, make sure your spouse's information is correct, okay? Take a look at your Lifestage investment management profile. Bob mentioned talking to the annual conference about retiree medical, particularly important if you're going to retire next year or maybe in a year or two, just to get an idea of what that looks like. It's better to know now so you can plan. That way you won't have any surprises. Think about what you need to do for housing when you retire. Bob mentioned, will you need to buy a home? Will you need to come up with a down payment? Will you need to roll money out? we haven't talked about loans, but you can actually take a loan from your UMPIP account, um, and then you pay that back into your UMPIP. Run a benefit projection. It's a terrific way to understand what things look like in the future. Then call EY. And now you're very well prepared to engage in EY. No question too big, no question too small. And then you can also register for that benefit education consultation. And beginning in 2022, you can actually meet with a benefit educator, yours truly, Bob or Frank, and we can answer any of your questions around your benefits as well. We are hosting a Clergy Benefit Academy and a Rev It Up in Broomfield, Colorado. I was just in Denver last week and it was glorious. The mountains looked just like that. I miss them already. So it's Clergy Benefit Academy is March 28th through March 30th, and then Rev It Up is March 30th through April 1st. By then, the high temperatures should be in the 70s, maybe low 50s, low 40s, so a wonderful way to begin your spring. So please consider enrolling in one or both. We have some resources for you. We like to put these out. So the Wespath Participant Solutions is available at that phone number there, 800-851-2201. If you have a question about your benefits access account, what have you. Wonderful resource, great group of people. Benefits Access, you can go there directly and log into your account. They do also have a mobile app. The mobile app is read-only. So that means that you can't make any changes from it. But you have the ability to check your account balance while you're in line at the grocery store, which I think is pretty cool. And then one last plug for EY. Their contact information is listed there, as well as the website that you can go and sign up for your EY Navigate. Definitely well worth the effort there. And this concludes the webinar, the pre-retirement webinar. We thank you so much for attending, and we thank you for your service.